China's inflation rates are higher than expected, the US dollar is rising with higher US growth expectations for now, and the Philippines GDP is much weaker than forecasts. That's coming up in our 5 Things in 5 Minutes on Monday, November the 10th. And then in our deep dive interview, ANZ's Chief Economist for Southeast Asia and India, Sanjay Mathur, details why consumers in the region have responded so weakly to rate cuts.
Despite rate cuts, real rates have remained quite high because inflation has fallen quite sharp. And then if you overlay it with the fact that consumer confidence is weak, there is really no catalyst for Asian households to borrow even at lower rates.
But first, in 5 and 5 with ANZ, China reported better than expected price inflation data for October last night, with consumer prices rising 0.2% from a year earlier. Economists had expected it to be flat. The inflation came from an unusual source, the price of jewellery, reports ANZ senior China strategist Xiaopeng Zheng. Even though jewellery makes up just 1% of the consumer price index, of course the costs of its main components are up dramatically.
Year-on-year gold price, silver prices surged almost 50%. So jewelries will contribute almost 0.5 or 0.6 percentage point to the headline CPI. Except the jewelries price, another big contribution is the low base last year. So we expect both factors will be in play in the next few months. China's CPI will go up to 0.5, almost 0.5 in December.
Markets closed mixed over the weekend, with the S&P 500 ending up 0.1% and the Nasdaq down 0.2%. The yield on the US 10-year Treasury closed unchanged at 4.10%. West Texas oil futures rose 0.5% to $59.75 US a barrel. Gold rose 0.5% to $4,009 US an ounce. The US dollar index fell 0.1%. The Aussie dollar rose 0.2% to 64.94 US cents, and the Kiwi fell 0.1% to 56.27 US cents. Number 2. So what might that stronger inflation data from China mean? Xiaopeng says inflation may be up, but consumer demand remains weak, and it doesn't stop the People's Bank of China from needing to ease again, possibly in December after some key policy meetings.
China economic data was weak, but it was very stable. So I don't think the weak data can trigger any policy response, because the 5% GDP target remain a low-hanging fruit for the authority. We expect the next time window to watch for the policy change will be in December at the Politburo meeting and also the Central Economic Work Conference.
Number 3, the US dollar has risen in recent weeks because of a re-rating upwards of US growth expectations and therefore interest rates. ANZ Head of FX Research Marja Ben-Zaman says that pressure remains upwards on the US dollar in the short term.
The price gauge suggests that the Fed has some ground to be cautious around inflation pressures coming from core CPI looking ahead. Further to that, we've also seen a little bit of more cautious, mildly hawkish Fed communication so far. So we have seen yields broadly a little bit higher as well relative to other G10 currencies or yields. And as a result, we think the dollar will likely remain firmer in the near term.
Number 4, but Marja Ben sees the US dollar reversing closer to the end of the year.
We think that the US shutdown has limited the market of data such as the traditional non-farm payroll, CPI, retail sales, which effectively probably show a softer growth picture than survey data. And so, once data releases at the end of the US shutdown come out, and if they are below expectations, we think that, the dollar will reverse lower in line with our year-end forecast.
Number 5, growth data for the Philippines on Friday was much weaker than expected, with GDP rising 4% in the September quarter from a year ago, when the market had expected more like 5.3%. ANZ economist Arundam Chakraborty says governance issues pushed government spending lower, with a recovery not likely anytime soon.
Confidence indicators from both businesses and households remain weak, while credit growth has slowed over the past 3 months. This suggests that transmission of earlier rate cuts has been limited. Given this backdrop, the government's official GDP target of 5.5 to 6.5% looks increasingly out of reach. We have revised our 2025 GDP forecast lower to 4.9%. With inflation expected to remain benign, we anticipate 2 additional 25 basis point rate cuts from the BSP in subsequent meetings.
Arindam Chakraborty there. Now, in our deep dive interview, ANZ's chief economist for Southeast Asia and India, Sanjay Mathur, has surveyed the reaction of economies across the region to the current cycle of rate cuts and has found that consumer demand, in response, has been unusually lacklustre this time around for almost all countries, except for the Philippines. He sees a couple of reasons.
The first is that consumer debt in much of the region now is either high relative to the level of per capita income, or it is in some cases around above 60% of GDP. That's a level that's considered to be a debt-ring level by, say, the BIS. And finally, in some cases, it is also exceeding that of developed countries or advanced economies. And that's quite in contrast to many advanced economies where household leverage has actually come off over the years. That is the primary reason. Thereafter, we can look at other things. The house prices, which is the main form of wealth of Asian households, that has really not appreciated very much. So wealth effects have been quite limited. And finally, one of the biggest challenges we have in the region is that despite cuts in rate cuts, real rates have remained quite high because inflation has fallen quite sharp. And then if you overlay it with the fact that consumer confidence is weak, particularly with regards to future incomes, etc., there is really no catalyst for Asian households to borrow even at lower rates.
So has this surprised central banks and forced them to change the way they are responding?
I would say it has surprised central banks. And that is why we have also seen that the rate cutting cycle has been extended in some countries. If you look at Indonesia, for example, we look at Thailand, we look at South Korea, it has definitely been extended over and above what even the central banks were anticipating initially.
Could you talk a bit more about the particular economies and the relatively modest wealth effects? Because through COVID, there were some economies where there was significant growth in house prices in particular and in stock markets. What's the story in various economies in Asia?
I think pretty much across the board, what we saw was that immediately after COVID, there was a flurry of buying and property prices did go up. Thereafter, over the last 2 years, we've seen a reasonable amount of stagnation in most economies. The only economy where we've seen that has really bucked the trend has been Singapore. To a lesser extent, more recent data in South Korea is also pointing to an upturn in property prices. At the other end of the spectrum is obviously mainland China, where we've seen property prices fall, not even stagnate, and that has resulted in sort of a negative wealth effect for the household sector.
And could you give us a sense of how consumer confidence has played a role in this modest response?
So consumer confidence has really been weak in the majority of economies, even though, and this is quite striking because unemployment has generally been quite low in the region, which means that the bulk of the jobs created in the post-pandemic period have been low-paying jobs in the recreation sector, in the hospitality industry, and therefore wage growth has been quite mild. At the same time, in some economies like Malaysia and Thailand, of late we've noticed even this wage growth is starting to moderate. Therefore, there is genuine skepticism on the part of consumers about the well-being into the future.
Just finally, are there any exceptions to these rules or exceptions to the experience this time around?
There is some heterogeneity across economies, and I think that the gold standard in Asia really is Singapore. Singapore households have deleveraged, they've increased over the years, they've increased their holdings of financial assets, and property prices have also moved in the right direction. Therefore, we think that if there is a household sector that's willing to borrow or should be able to increase their leverage, it would be Singaporean households. We also think, particularly after the elections were over in South Korea, exports have been strong. So there is a comeback in consumer confidence in South Korea, albeit to a milder extent.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, November the 10th. Catch you tomorrow with a preview of Australia's labour force data due on Thursday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.